Would you like to invest in property with less risk, less hassle, and less money than normal? No, this isn't a weird scheme that Rob and I have cooked up. This is the world of property funds. And if you don't understand that world, by the end of this episode, you will.
Welcome to the Property Podcast, where every Thursday property investors come to be informed and inspired. This week we're talking about a whole side of property investment that we've never talked about before, and it's a big one. So stay tuned for that and stick around to the end for Hub Extra, where Rob B is going to be recommending another podcast you'll definitely want to check out.
So over the last few years, landlords have been hit quite hard by different changes to taxes, which ultimately have meant that we're paying out more each and every year. Now, because of all those raises, we've probably been relaxing, thinking there can't be any more. It just can't be, right? Wrong. This week, there were loads of headlines around proposals to increases in capital gains tax. Now, the headlines are quite scary, so of course we need to discuss them. But it's worth pointing out right from the off that these are proposals and nothing has changed just yet.
That's right. Back in summer, the Treasury asked the Office for Tax Simplification, who I would argue are not doing a great job in general, to write a report into capital gains tax and take a look into whether anything can be done to change it. It wasn't meant to be in the context of a tax grab necessarily. It's just what can we do to stop tax from distorting behaviour and make it all a bit easier. So this paper has been written. They are just proposals, but it hasn't stopped the headline writers going into overdrive. So on the BBC, we've got capital gains tax. Rates should double, said government review. It doesn't actually say that. And in Landlord Zone, it says Sunak gets the green light to drop CGT bombshell on landlords and property investors, which again is a bit misleading because landlords and property investors aren't mentioned. But still, it's not good news for property investors or any kind of investors really, if this happens, because the basic proposal is that capital gains tax should be aligned with income tax bands. So at the moment, the general rate of capital gains tax is 20%. For property, is 28%. If it was aligned with tax bands, and so you were paying in the 40 or 45% band, then that's what you'd be paying on your capital gains as well. They also talk a bit about the possibility of removing or reducing the annual allowance, which is also not good news. But on the upside, they also talk about the importance of indexation if they do start doing these things. So in other words, you're not paying for just inflation-related gains, which would in fact be really good news. So we'll cover this more when we do Market Update in a couple of weeks' time and get into the details of it a little bit more and talk about what it might mean. But for now, you just need to know that capital gains tax going up would not be good news for any investors in anything, but it's not specifically targeting property investors and, at the moment, only proposals. Did you know that you can invest in property without having to own the whole property, without needing to get a mortgage, without needing to speak to a solicitor, without needing to make any effort beyond making a few clicks? You might not know this because, believe it or not, we have gone 400 episodes without talking about property funds, which is what I've just described. When most people think about property investment, they think about what we do speak about most weeks. They think about buy-to-let, or they think about flips. They think about doing a refurb. But there is an entirely different way to approach property. It is very different. There are advantages and disadvantages, which we'll talk about in this episode. So why might this be interesting for you? Well, for a start, this alternative way of getting involved in property requires far less cash. So there are a lot of people listening to the Property Podcast because they want to invest one day, but they're not in a position to have the money. Or maybe you're thinking, I'll never be able to save up enough to buy a property of my own. Well, this topic could be very relevant to you. Or maybe you're listening because you've been involved in property for a long time and the shine's worn off a bit. You're a bit sick of all the effort and the hassle and the challenges that being hands-on in property inevitably comes with. Well, if that's you, you'll want to listen to this episode as well.
So Rob, what is a property fund? The fact that we're doing a whole podcast on this suggests there's a bit to it. And I can imagine myself rambling on for about 20 minutes here trying to explain what a fund is. So in the interests of everyone, especially our editor, can you explain succinctly what a fund is?
I'll have a go. And there's lots of different types, all of which are a bit different. And we'll come to those a little bit later on. But at a really high level, a property fund is just a way that people can collectively and indirectly invest in property. So collectively, in that you're going to have many hundreds or thousands of people owning a little slice of the portfolio each, and indirectly, because those people are not actually running the portfolio day to day, they delegate it to someone else. So really simply, everybody puts money into the pot, the fund. The fund then goes out and buys property. And as a contributor to that fund, you get a tiny little ownership stake of everything within that fund, everything that the fund holds now and everything that it goes on to buy in the future. So this is a really important point. It's not that you invest in what the fund happens to own at the point you invest. You have your little piece of the overall whole, whatever that looks like at whatever point in time. So what are the benefits of doing this? Well, although you experience these benefits in different ways, they're the same two benefits that you get from owning property directly. The properties in the fund generate rental income, which you get your little share of, and hopefully the properties in the fund go up in value. So even though the structure is different, the portfolio is very different, the experience is very different, the purpose is still the same. It's still the rental income and the capital growth that you'd be pursuing if you were going down the buy-to-let route.
Beautiful, Rob, and zero edits needed. Fantastic. So, why would you invest in a property fund? Well, Rob's already talked about the rental income and capital growth, so that's great. But why not just invest in normal property yourself? Well, there are other benefits. A big one, and this is a big driver for a lot of people, is diversification. People sometimes will perceive property as risky, and it can be if you don't know what you're doing, and it can still be risky even if you know what you're doing. But by investing in a fund, in most cases, you're investing in a wider portfolio. So how does this help you? Well, let's compare the two. Let's say you buy one property. If things go well, then fantastic. But if things don't go well, not as good. If you've got void periods, then you've only got one property. The void periods are on that one property. If you have maintenance issues, again, they're on that one property. Whereas if you invest in a fund, you're investing in multiple properties. So if you have a fund with 100 properties in, and one is void or two are void, then you don't really feel the pain because you're getting income on the other 98. Same for maintenance issues. There may be maintenance issues on one or two of them, but the chances of it being on the entire fund are low. So people like it because it can be seen as less risky than investing directly. It also gives you the opportunity to invest in some different types of property assets. So traditionally, most people will invest in buy-to-let residential property. But through property funds, you absolutely can do that. But actually, it's more common through a fund to invest in commercial property, such as shopping centres, office buildings, or warehouses. So there is a variety of asset classes within property that you can invest in. And by investing through a fund, it gives you access to those asset classes. You don't have to arrange mortgages either. Your fund may or may not take advantage of leverage, and that would be something you'd want to check. But you don't have to get a mortgage when you put your funds in. And obviously, not having the hassle of getting that mortgage is a big win. But again, not having the hassle of owning property overall is a plus point too. I've just mentioned things like void periods, maintenance issues. It's not your problem. The fund will deal with it. You just collect your returns at an agreed point and enjoy whatever capital growth comes your way.
That lack of hassle is a big one. But there's another big one as well, and it's one that I mentioned back at the start. You don't need as much money to invest with. So if you're investing in a single property, we usually say that you'll need about £30,000. You could do it with less. You could probably get away with around $20,000 on cheaper properties, but that's still a lot of money. When you're investing in a fund, you don't need anything like that amount. Some funds will have a minimum, but others won't. So the practical minimum could be as little as £50 or £100. Now, of course, if you're only investing that much, then you're not going to make life-changing returns from your investment, however well the fund performs, because you don't have much at stake. But still, you've got access to property, you've got exposure to property that you wouldn't otherwise have been able to have. And finally, it depends on how the fund is set up, but often you can hold your investments in a more tax-efficient way. So many property funds can be wrapped up in a pension or in an ISA. We don't need to get into all the benefits of those now, it's beyond the scope of this episode, but depending on your personal circumstances, that can make a big difference to the amount of your investment that you actually end up seeing yourself rather than giving away in tax. So hang on, this all sounds amazing. Have we just been on completely the wrong track for the last 400 episodes? Should we just been investing in funds all along? Well, of course not. If you've been listening for a while, you'll know that there is no type of investment that is the best. There are always pros and cons, and we will talk about the disadvantages of investing through funds. But first, Rob, I think it's worth exploring the types of property that you can actually invest in through funds, because it's broader than people would probably think.
Yeah, I've touched on this a little bit already, but you do have so many options. So like I've said, you've got all the commercial type aspects. I've mentioned some already, but you can go further. You can invest in healthcare units, care homes, private hospitals. You can invest in petrol stations. I mean, the list is endless. What may surprise people is the dominance that commercial property has in the fund world. Residential funds are few and far between. They make up a small percentage of the overall fund world. And that might be one of the reasons that people don't automatically run towards funds as their first choice of property investment, because the heavy leaning to commercial. People understand normal buy-to-let. You know, you live in a house, the concept is easy. Commercial, though, okay, we go into commercial buildings, but it's not something we live with. It's not something we know inside out, at least the majority of us anyway. So investing in commercial can seem a little bit alien to us. So there is that knowledge gap. And investing blindly, as we've talked about, is risky. I think it's still beneficial to understand the asset class that you're investing in. So for most people, there will be a bit of a learning curve that you'll need to go on to understand the type of property you'll be potentially investing in. But beyond that knowledge gap that people will have around the asset classes, there are other reasons as well why people may choose not to invest through a fund.
Yeah, we promised you some drawbacks, so let's get into those now. The first is an obvious one. You lose control. If the appeal of buy-to-let is it's an investment that you can see and touch and understand and be involved with and do the critical parts of yourself because you trust yourself to do it right, then a property fund is not going to give you that. Now, you're delegating control to professionals. This is what they do, and they do it at scale. So you'd hope that they do it pretty well. But the control aspect of investing directly in property is a big one for a lot of people, and that is something that you don't get with funds.
There is also an extra layer of fees. The people running these funds aren't doing it out of the goodness of their hearts. They want to be paid as well. So at the very least, there'll be management fees against the fund. So typically, but not always, the management fee is around 1%. So if you've got £100 in a fund, then each year you'll pay £1 for that privilege. But hopefully, if your fund is doing what it should be, then you'll be making a rental return and capital growth. But if it has a bad year, you still pay that pound. So while it may not be extortionate levels of fees, there are fees to consider.
Another disadvantage is that if the property market is doing poorly, you might not be able to sell your shares in the fund if you want to get out, or at least you might not be able to sell them at a price you're happy with. We'll talk about the different types of fund in a minute, but there are some where if the market is struggling, they will stop anyone from taking money out. They'll gate the fund, is what it's called. And there are others where you will be able to get out, but if everyone's trying to get out at the same time, the price of the shares in the fund can plummet. Now, really, that's not that different from owning a property directly. If you've got a buy-to-let and the property market is struggling, you might not be able to find a buyer, or you might need to cut the price dramatically to find a buyer. But still, because you can see the price of your share in the fund, it probably feels a bit more painful to be in that investment when the property market is not doing well. And Rob, that visibility of prices that you get with a fund that you don't get with your own investment can be a whole separate drawback of its own.
It can, because the value is more volatile. Share prices might move from minute to minute, whereas you never really know what you could sell your property for from year to year. Something you need to know and understand is the value may appear more volatile because the share price can move minute to minute. And if you keep an eye on that, it could be quite stressful watching the value of your portfolio move around. Now, ultimately, like property itself, it doesn't really matter what the value is until you sell. But the thing about your own property values, you haven't got something in your face saying, right, today it's worth this, now it's worth this, and it's moving around day to day. It's only when you take the time to get it valued that you then understand your pricing. But with some funds, you can see to the minute exactly how your fund is performing. And some people may not like that. Some people may be able to detach themselves. And actually, I'm not even going to look at it. I'll just look at it once I cash out at some point in the future, or I'll just review it every year. But for others, they'll have it on their phone, checking it every day because they've just become that new obsession. So it's just something to acknowledge and be aware of. And if you're the type of person who's going to get obsessed by the pricing, then it might not be for you.
There's one more drawback, and it sounds a bit trivial at first, but actually I think it might be more significant than any of the others, which is that it's a bit boring. Property, for most people, just is more exciting than other types of investment, like investing in shares. Not everyone, but a lot of people. And the excitement of having an investment that you've been involved in picking out and setting up and you know who lives there. For many people, that is a big attraction of investing in property. Now, when you've been in property for a while, that wears off a bit and you discover that it's not actually that exciting after all, and you could do with a bit less excitement in your life. But nevertheless, it is a big draw to property for many people. Investing in funds, on the other hand, is boring. You don't get any of that. The research is quite boring. It's just reading a load of documents. The process of making that investment is very dry. And then after you've made it, not much happens. You get paid every so often. You get an update every so often, but you're not involved with it. It's just a bit dull.
It is. And I think the fund operators have a lot to answer for here. Well, they do and they don't. You could say they don't put enough effort in to make it more exciting for the end user. But when you look at who puts the most money into these funds, you can understand why they don't. Because the majority of the money that goes into funds is institutional money. So, for example, pension companies will put billions of pounds into property funds. And individuals make up a much smaller slice of the pie. So they don't talk to individuals. But if these funds actually updated the investors, made them feel more ownership of what's going on. It doesn't remove everything that Rob's just said, but it'd go a long way to make it a more interesting experience, especially for people who are new to property, who don't have enough funds yet to get fully involved, but want to have some exposure to the property market and learn. You could invest and learn, but you'd have to dig through a prospectus, which is probably 100 plus pages long, which is pretty dry and boring. So you can understand why it puts a lot of people off. But if you can get over those downsides and the plus sides are enough for you, then you have some options. We've talked about the options of the types of property you can invest in, but there are also different types of funds. Now, some of these are only open to high net worth individuals, but we're going to focus on the ones that are open to anyone. And the first of which are open-ended funds.
Yes, this is the big distinction, open-ended versus closed-ended. And this is also where the jargon starts coming in. As with anything in the investment world, there's loads of specialised vocabulary and it can be really hard to actually work out what it is you're looking at. So open-ended funds are also known as PAIFs, they're known as unit trusts, they're known as OEICs. Those are all slightly different, but they're all open-ended and that's what matters for our purposes. What does open-ended mean? It means that anyone can put in money at any time and anyone can take out money at any time. So investors put money in. The fund buys property with that money. That property generates rental income, which gets paid out as dividends. And the value of that property goes up over time, which is reflected in the value of the shares going up. Happy days. If more people then want to put money in because this fund is doing well, then the fund has to accept that money and therefore the fund has to go out and find property to buy with that money. But then say the market takes a turn for the worse and everyone wants to get their money out of the fund. Well, because it's open-ended, the fund has to give everyone their money back on demand. So that could mean if lots of people are wanting to sell, the fund therefore has to sell some of the property that it owns to pay everyone back. Why is this a problem? Well, two reasons. First of all, if everyone wants their money out because the market's not doing well, then it's forcing the fund to sell property at the worst possible time for selling property. It could be the case that if you wait a year, then everything's picked up again, but the fund doesn't have that option. It has to sell because everyone wants their money out. The other drawback is that property is hard to sell, especially some of the bigger types of property that can be in some of these funds. So if you own a shopping centre, for example, finding a buyer for that can take a really, really long time. So you might not be able to sell at all. So what ends up happening is that the fund ends up getting gated. They effectively say, sorry, I know we said that under normal circumstances you can have your money out, but we're just not able to do it. And when that happens, everyone gets quite upset. So if you've seen negative press around property funds, chances are, if you check, it's talking about open-ended funds, and chances are that's the reason for the negative press. It'll be the fact that your money was meant to be accessible, but then they've had to gate it, and so it's not.
So the opposite of open is closed, and you have closed-ended structures. Now, while no investment structure is perfect for all situations, I don't think it's a stretch to say that closed-ended funds are going to be better suited to most people. So what are closed-ended funds? The most common structure is a REIT. And that's not a welcome in Newcastle, that's a real estate investment trust. It'll be listed on a stock exchange, so you can buy shares in it. But unlike an open-ended fund, it's not forced to create or destroy shares based on the demand, which is good because it can make long-term buying decisions without worrying about capital. If you want to sell, you can find another buyer on the stock exchange. The share price will be based on the value of the property, and it's also market sentiment. So there are some clear advantages there. Now, by law, a REIT has to pay out 90% of its rental income as dividends. So this is really attractive if you're looking for cash flow, because you know the majority of the income is going to be paid back to you. And there are tax benefits as well, such as a REIT doesn't have to pay corporation tax. So if you invest, say, through an ISA, then no tax gets paid at any point. So it starts to become really attractive for the end user. So now you understand what a fund is, you understand the pros and cons and the type of fund structures there are. If this still sounds appealing, then how do you go about picking a fund?
Well, there are a few steps to go through. So to start with, you have to decide what type of property you actually want to invest in. As we said, there are all different types of property held within funds. There are funds that specialise in every type, and there are also some that have more of a mix. So it's easy to get blinded by all this other stuff, but ultimately, that's what really matters. What is the underlying thing that you want to invest in? Then you can look for funds that invest in that particular type of asset. Next, you want to have a look at how those funds have performed historically. So you can look at historically how they've done in isolation. And the thing to look at is the total return. So if you add up the growth in the share price with the rental income that's paid, what do you get paid each year in total for being in that fund? You can look at it in isolation. You can also look at how they've performed against other similar funds. But to see how well the fund is being run, the best thing to look at is actually how they've performed against their benchmark. So every fund will have a benchmark that it measures itself against. So you can say, okay, this fund invests in retail property. How has this fund performed against retail property in general? And that's an important question to answer, because if you look at retail property, for example, over the last year, it will have done terribly. All retail funds will have done absolutely dreadfully, but that's because retail property in general has done badly. It doesn't tell you how relatively good each of those funds is. So that's where comparing funds to each other and to a benchmark comes in handy.
Next, you'll need to see what type of return they give or what dividends they pay. Of course, this is only important if you're driven by the income side of the fund. If you're more driven by capital growth, then this may not sway you as much. But of course, the capital growth will help up make the total return, which is the dividends plus any capital growth you get. So you're still going to want to look at this. You may have a benchmark that you want to meet to be satisfied, and that's fine. Make sure you look for a fund with that level. But also remember, like with all investments, if you're looking for a higher return, then you're probably going to be taking a higher risk, and you have to accept that. And finally, read the annual reports. Now, yes, a prospectus may be a little bit dry, but the annual reports are readable. I'm not going to suggest that they're going to be the first choice of things you want to read each week, but they're not that bad. You should absolutely give them a read if you're looking to put money into one to understand exactly what you're investing in. Because as we talked about before, that knowledge gap, if you don't understand the asset class you're investing in, then you're leaving yourself really vulnerable. So make sure you put that time into research. You can switch off after you've invested, but before you invest, still apply that due diligence.
So there you go. That is your beginner's guide to property funds. Is it something that's going to completely replace buy-to-let for you? Probably not. It is a very different type of investment, especially because there's so little in the way of property funds that invest in residential buy-to-let type property. So for that reason alone, it's just not the same thing. But we could hardly really call ourselves the Property Podcast if we didn't acknowledge indirect investment through property. There are trillions of pounds invested through property funds, and for some people, it'll be exactly the right way to invest. So as always, it comes down to the same thing. Know your goals, know what you're investing for, educate yourself, do the research, and make your investment choices from there.
So it's time for Hub Extra, the part of the show where we give you more. And of course, this is all backed up by the Hub Extra email that goes out each and every Friday. If you join the Property Hub website, which is completely free to do, you will get that little gem of an email delivered to you each week. And we aim to make it the most useful email you get in your inbox. Let's make this part of the show useful by giving you a Hub Extra resource now. And that resource is a podcast episode. So out on a walk recently, I decided to pick up a new podcast. And the podcast is called Bold Flavors or Bold Tea Flavors. And it's a podcast by the founder of Gusto. And he interviews different people every week. Now, I'm only recommending an episode because I've only listened to one episode, and I will go on to listen to more. But I enjoyed the episode that much that I wanted to share it as a resource. And that episode was Timo, the founder, interviewing Joe Wicks. Now, everyone loves Joe Wicks, so it's great to hear him on a podcast. But for me, the real pleasure came from him talking about his business rather than food or exercise. Don't get me wrong, I like my food and occasionally I like a bit of exercise, but it was really interesting to hear the business side of his world. And Timo, the founder of Gusto, has a huge business. I found out on that podcast that they employ nearly 1,000 people now. It's a business that is on the up and up. And to hear those two engaged in conversation was really good. So on a personal level, I really enjoyed it, and I'm sure many of you will as well. And if you enjoyed that episode, leave them a review on iTunes to just getting started and let them know how you found it.
So that is us done for the Property Podcast once again. Property funds covered off. Hope you learned something new and got something out of this episode. Next week, we're getting back to the hands-on and sharing the experience of what 2020 has been like for some real-life investors. So you won't want to miss that one. But before then, we'll see you on Tuesday for our Scrub and Rub. Until then, bye-bye.
Bye-bye.